Let's talk about that when it comes to dividends, right? So let's just get to that part first. Remember, there's two ways that we can get paid, right? The first way is through dividends, right? So we understand that dividends is the cold hard cash that not every company, but dividend paying companies pay to their investors, right? So here's the thing. Every company doesn't pay dividends, y'all. Every company doesn't pay dividends. But just because the company doesn't pay dividends doesn't mean it's not a great company. Think about your Facebooks, think about your Amazons, think about your Googles, think about your Teslas, think about your Netflix. We can go on and so forth. What happens is when a company doesn't pay dividends, what they'll do is instead of paying that cold hard cash to you as an investor, they take that money, pour it back into the business. And then you get the reward of seeing your equity grow in the business, right? I see a question. What makes a company decide whether or not they pay dividends? Let me answer that question if y'all don't mind. So what happens is a company will get to a certain state or a certain level where they feel like, yo, our growth isn't as much as it was early on, right? So Amazon has so much growth in it, it probably wouldn't pay a dividend for the next 10, 20 years, right? 10 years or something like that. Right? But Apple has been around so long, they still have growth, right? And they feel like, yo, you know what? We want to reward our investors for this. Now, what you'll see is two of the things I look for just to get y'all in this, and I want to take y'all off. When we looking at dividends, I look at two things. One is the payout ratio, meaning how much are they paying out of their profit to us? Right? For me, I would like a company to be paying me anywhere between 50 and 65%. Well, Trap, why not more than that? Because I'm not a greedy investor, right? Because they're paying me 75% of their profit, then now they can't grow the business like I want. And so I would rather take my money a little bit in the dividend, but more in the growth, because as long as we see growth, as long as they're adding value to the business, the share price is going to continuously increase at a good pace. Does that make sense to everybody?
Yep.
We trapping?
Mhm.
All right, cool. All right, so that's where the decision comes in, right? It's saying, okay, if we were growing at 15, 20, 30, if we were growing at 60% a year and our growth rate has scaled down to about 20%, okay, let's start paying some dividends because we want to reward people for being with us, right? And we don't want them to feel like they got to go somewhere else, right? So dividends, one, is a great style of investing, but it's also a way for companies to reward you for believing in them. So let's say we go back to EYL. EYL is going to be the reference we're going to always use, right? So what happens is right now EYL will be what I would call a young buck, right? This is in a while back I broke down how I look at companies, right? So EYL will be a young buck. They new to the game. They got a whole lot of potential, yo, right? They're going to make some mistakes along the way, but that's what happens in a growth process, right? So what happens is this, though. They're not going to pay us no dividends right now because they're taking every dollar that they make to reinvest into the business. And so because they're reinvesting into the business, they can still grow at a rapid rate. Y'all with me?
Mm-hmm.
So now check this out too, though. When a company does pay dividends, here's the pro to it. When a company does pay dividends, what happens is anytime you see a market correction or a stock price is falling, dividend paying companies don't fall as much as everybody else. I like to use this analogy. You ever got a butt whipping from your mama before, but then you said, you know what? I know I'm about to get this ass whooping. I'm going to go put another pair of pants on. I mean, if I ever did that, I'm going to go put another pair of pants on. So you put another pair of shorts on, you put another pair of pants on right quick, and that kind of take the blow away, right? Or so you thought until she started hitting you on your wrist and then your back. And then you're like, damn, I ain't had no protection for that, right? So that's what happened with dividends. So most often what happens is when a company pays dividends, because they're paying the dividends, because they have that cash for that, they often don't take the same hit as it would if it wasn't paying one. Does that make sense to everyone? Does that make sense? Is that we locking in right here? We tracking y'all.
And dividends are not guaranteed. Like they can stop dividends at any point in time. Right?
100%. So again, at dividends, so we looking at this. So now we tap into something else while we just talking about dividends, right? one of the things we want to look at is a track record. And this is why we don't want you. This is why that other one made sense about the payout ratio, right? So what happens is this: a company that has, and this will get a little bit into like finance, what I get into with it, but we want to be invested in businesses with great financials, with businesses with a lot with cash on deck, positive cash flow, positive cash on deck. And I don't want to go too over people's head because we want to keep it in that 101 sector. But the reason why we want that is because in hard times, what we don't want them to do is cut it. See, during the pandemic, a lot of companies did two things. They cut the dividend or they suspended the dividend. The reason being was because they didn't have enough cash to withstand. One, they didn't know how long the pandemic was going to happen. So they didn't have enough cash reserve to say, okay, I can still pay my dividends and take care of my business financially. One of the two things got to happen. I got to cut this dividend so I can make sure the company stay afloat, or I'm going to take on more debt to stay afloat. You never want those two things to happen. So you saw companies like Exxon, you saw companies, cutting their dividend, pausing their dividend, airline businesses, cruise ship businesses, cutting their dividend, freezing them because they couldn't do it. They couldn't burn $60 million a day because nobody was flying and still pay you a dividend, not knowing this was going to take another year and some change, right? So they cut it or they freezed it or whatever. You don't want that. You want a company that's in a good financial state that can continuously pay you that dividend. And so some of the companies you'll look at was called like dividend aristocrats, dividend kings, dividend challengers, right? These are companies that have paid dividends for 10 years, 25 years, and 30 years plus. But I don't want to go too far down the line with that, right? But that's
real quick. When a company suspends its dividend, is there usually a time frame when they can pick it back up?
They can't. So it's up to them. Like, when do we get our finances back on track? What does the future look like? Is the industry picking back up? Right? You start seeing things like that. So now they got to make a hard decision. They got to make that financial decision. And that's not a decision you want to have to worry about. Right? So if you're going to pick a company, so let's even say this, right? I want y'all to know this before I get into the other way. When you're looking at dividend paying companies, you want to look at what's called that dividend yield. Right? So let me tell you what the yield is. The yield is simply the portion of the stock price that's being paid out to you in cash. So if the company's dividend yield is 7%, you take 7% of that stock price and you'll know exactly what you're getting as a dividend. Right? So if Apple is $200 and something and their dividend is 1.9%, then you take that 1.9% and that'll give you what they're paying you as a dividend. Make sense to everybody?
That's a fact.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.